Good day, everyone, and welcome to this RMA Risk Readiness Briefing Special Coverage Series. I'm Stephen Martin, and I lead the Business Solutions Group at the Risk Management Association. The RMA is pleased and proud to make this presentation complimentary to members, and if you're not already a member, I urge you to explore all that RMA has to offer, and you can do that at rmahq.org. Today's webinar is the latest installment of our Credit Trends in Commercial Lending. It's a part of our risk analysis service, and it's presented today, as always, by our friends from AFS, Tom Cronin and Jeremy Chalson. During the presentation, if you have a question for the speaker, click on the Q&A button and submit your questions there. And as always, we will attempt to address as many of those questions as time will allow at the end of the presentation. Also, just a few other housekeeping items before we get started. If you run into any technical difficulties during the event on this platform, please make use of the help widget in the form of a yellow question mark at the bottom of your screen. Also, this platform is customizable, so feel free to move the widgets around on your console to your preference. All right, so at this time, then I'd like to turn it over to you, Tom. Tom Cronin from AFS, thanks for joining us today.
Thanks, Stephen, and welcome to everyone on our last RES webcast for 2020. Now, what a year this has been, and I think we're going out with some interesting results, especially when we examine delinquencies and non-accruals for both C&I and CRE. So we're going to spend a few more minutes on performance for October 2020 than we usually do. So let's get started. So we're going to review the October 2020 data results, first for C&I and then for CRE, and we'll conclude with a quick summary and entertain questions after that. A quick note about the source of the data for those who are new to RAS. The Risk Analysis Service, or RAS as we call it, started in the third quarter of 2003, and now we collect data on a monthly basis. RAS has about $1 trillion in exposure and over 700,000 loans, and enables banks to compare their portfolio to a select set of peers and determine what they have and how is it doing versus the peer group. So we're going to start with C&I and a quick definition of C&I. These are loans to private and public companies, usually with annual sales greater than $1 million. These loans are manually underwritten and risk rated, and the loans secured by owner-occupied real estate are included here. Let's start with a look at loan performance, specifically the level of non-accruals and delinquencies. If you focus on the blue line, which is the percent of loans 30 to 59 days past due, you see that there's been a lot of volatility over the past year, year and a half. And if you look at the sharp up and downs for 2020, and then go back to the left to 2008, 2009, you see we're experiencing the same shape of volatility, that M or W, as we saw in the recession. But the levels today are service highs. For September 20, we're back above 1%, something that did not happen in 08, 09. Actually, that's October 20. We're now at service highs. So let's focus on non-accruals, the red line. And unlike the frequent changes we're seeing with delinquencies, the non-accrual rate has been on a steady rise. At the end of 2018, the non-accrual level was at 0.69%. Since that period, non-accruals have increased almost every time period and now are above 1%, up almost 50% from late 2018. And we also saw a jump for loans 90-plus days past due. But on the next few pages, we're going to focus on the increase in short-term delinquencies and then non-accruals. Since we saw a big month-to-month increase in delinquencies, we're showing on this chart the 30 to 59-day delinquency level for this month, October, versus last month, which was September. And you can see the increase is widespread. 18 of the 24 NAICS sectors here saw an increase in short-term delinquencies. We saw October levels 3 times September levels for the following industries and subsectors: 22 utilities, 31 manufacturing, specifically food and apparel, 42 grocery, wholesale with grocery, 54 professional, which is computer system design, 55 management or holding companies, and 56 admin, support, and waste management, and broken down, that was armored cars. So these 6, along with 45 retail, 48 transportation, 52 finance, and 72 accommodation, are all above the market average. With this slide, we're looking at the short-term delinquency levels at the regional level. Now, there's a map at the end of the document that shows you how we've created each region, and a couple of thoughts here. First, with the exception of the Western Midwest on the far right side, we're seeing elevated levels in every region. Second, the Northeast continues to have the highest level of short-term delinquencies. And third, there was a huge spike in the Mid-Atlantic, and that region has gone from one of the best to one of the worst. And last, similarly, the West has deteriorated from an average region to one of the worst. Now, during our bulletin review meeting earlier this month, this slide drew the most comments. The delinquency level for October is greater than the delinquency level for September for every loan size, no exceptions. And most notably, we saw delinquencies for participations and syndications double. It's also interesting to note that the delinquency level tends to increase with loan size. And this is directly opposite of what we have historically experienced, and appears to be the result of deferrals and stimulus money for the lower end of the market. And now that those programs are ending, I wonder if we'll go back to the higher delinquencies for smaller loans. This is something we'll keep an eye on. Now we're going to take a look at the non-accruals. And because those levels have been gradually increasing versus the rapid rise we saw for delinquencies, you'll notice that the time period on these charts are different. It's October 2020 versus December 2019. And this will give us a more complete picture of the overall impact of the business shutdowns due to COVID-19. And it's hard not to look at this chart and conclude 3 things right away. First off, mining, oil, and gas has by far been impacted the most. In December 19, it had the highest level of non-accruals, but just slightly above agriculture. Now, as of October 2020, it's almost 3 times higher than the nearest industry, 55 management. And outside of oil and gas, there are 4 other sectors that have been dramatically impacted. Not as much as oil and gas, but still showing significant impacts. These are 55 management, 56 admin, 71 arts, and 72 accommodation. And many sectors have seen little or no change. Sectors such as 44 retail, 49 transportation, and 52 finance and insurance are among several industries that had a near 0% non-accruals in December 2019 and are still low, especially when compared to oil and gas or arts or accommodation. But if you recall our second chart today, where we showed the widespread increase in delinquencies, we've got to wonder if this is about to change. Will we begin to see more sectors with higher level of non-accruals? This is something that we'll keep an eye on next period. Here's another look at the non-accruals by industry. For this chart, we looked at the percent non-accrual for each industry for December 2019 versus October 2020 and show the sectors with the largest changes. This is just an easier view of what was on the previous slide. As we mentioned, mining, oil, and gas increased the most, followed by management and admin support. And on the next slide, we'll go a little deeper into the subsectors. So here's one last look at non-accruals by industry, now at the 3-digit NAICS level. These 14 subsectors have the highest non-accruing rates as of October 2020. All of them have a non-accrual rate north of 2% and top out at 19% for 213 support activities for mining. Now, many of these have already been mentioned in the previous slides. Industries such as oil and gas and passenger transportation and food, all high human touch areas. But there are a few surprises here, such as forestry and textile mills. And I think these are not so much COVID-19 impacted sectors as just historically risky lines of business. Now we want to take a look at non-accruals by other dimensions. Here we're comparing the non-accrual level for the 7 regions, December 2019 versus October 2020. Non-accruals increased in 5 of the 7 regions, led by a doubling of the non-accrual rate for the Southwest, where a lot of the oil and gas is. While quite a bit lower overall, the Western Midwest just about doubled too. And we saw significant jumps for the Northeast and South, while the West and the Mid-Atlantic stayed about the same. And one last look at non-accruals, this time for deal sizes. And if you can, let's mentally split this chart into 2 groups. Deals $3 million and less, kind of the middle of the chart, and then deals greater than $3 million and parts and syndications. If you look at December 19th, the blue column, versus October 2020, the red column, for the smaller loans, we really don't see much of a change. I suspect that if we plotted these as one size, the change would have been minimal. Now let's look at the larger loans, above $3 million. Each size grouping for these larger loans shows a sizable increase. And the largest increase is for participations and syndications, mirroring what we saw with delinquencies. And this seems to also hold, true with the PPP loans and the deferrals. So we're going to finish up our C&I analysis with a quick look at credit quality and loan growth. Here we're looking at the trend in detail of the percent criticized. And as we've mentioned on webcasts this year, we take each bank's native borrower risk rating and map that into the RMA 10-point scale. On that scale, 1 through 6 are pass ratings, and 7 through 10 are criticized, with 7 being special mention, 8 being substandard, 9 doubtful, and 10 loss. And after peaking in 2009, we saw a long period of improvement, culminating in a service low of 5.56% criticized in June 2018. And as recently as March 2020, we were slightly above that. But we saw 100 basis point jumps in May and June, and currently sit at 8.5%, as banks have reacted to the uncertainty caused by business closures related to the COVID-19. The industries with the current highest level of criticized loans are mining, oil and gas at 26%, accommodation or hotels at 22%, air transportation at 21%, arts, entertainment, and recreation at 18%, and department stores or retail at 17%. Now, excluding PPP loans, loan balances at most banks have decreased. On this chart, we compared loan outstandings for each bank October versus September, and tagged each change as an increase if it was up greater than 1%, flat if the change was between positive and negative 1%, and a decrease anything below 1%. And only 7% of our RAS banks had a positive change this month. And the recent results of the Fed survey would indicate that this will continue as demand is low and banks are hesitant to relax standards and lend money. Now we'll move on to CRE, and again, a quick definition. CRE loans are to borrowers where at least 51% of the loan repayment will come from rental or leasing income. These loans are frequently referred to as investor-owned properties. And after reaching service lows for delinquencies in mid-2019 and for non-accruals in March 2020, the performance of the CRE loans has deteriorated significantly. Delinquencies have been extremely volatile, and for October 2020, at 0.68%, it's almost double September's 0.36%. Non-accruals have also increased to 0.84% and are getting close to the levels we last saw in 2015. And October's rate is triple what we had at the start of the virus in March of 0.28%. So let's continue on the next two slides with a little more detail on performance by property type. Let's look at the short-term delinquency levels for the top 8 property types, and top equals the highest loan balances. And I don't think anyone's going to be surprised by the high level here for lodging. The problems there dwarf issues in every other property type and have skyrocketed to just below 7% for October. The only other property types that saw an increase in short-term delinquencies were mixed use, more than tripling to 0.36, and a minuscule increase for office. That being said, the real story here is the deterioration of lodging. When we look at the non-accruals for the top 8 property types, we see a little bit more action. 7 of these 8 have October non-accrual rates higher than September, and multifamily is the only type that dropped. Similar to what we saw with delinquencies, lodging dominates here and is at 1.6%, is double what we saw for retail, which jumped this month to 0.8% from 0.3%. We also saw significant increases for industrial properties. And this was a bit of a surprise given the surge in e-commerce purchases recently. So we're going to make a note to keep an eye on the industrial property type. We measure credit quality, similar to what we did with C&I, by detailing the trend in criticized loans. And as these numbers increase, the credit quality decreases. So going from the left to the right, you see the dramatic improvement in CRE as criticized loans shrank from 30% criticized to just 2.11% in March of 2020. Post-COVID-19, the percent criticized has jumped 5 of the 7 months and is now at 8.71%. with most of that being tagged as special mention and a smaller portion as substandard. And the property type with the largest balance of special mention loans is lodging, about double what we see for multifamily. And lodging is about 10 times the next type for substandard loans. So here we're taking a look at CRE growth, and if you think back to the C&I growth, the red column, which is a decrease in outstandings, was the predominant results for C&I. For CRE, it's not great news, but it's not quite as bad. CRE balances are basically staying steady, and as we've moved into the winter, I expect this might move a little bit to the red. So that's October 2020. Delinquencies and non-accruals for C&I and CRE both increased, and the credit quality was about the same as September. Balances for C&I dropped, but were steady for C&I. So, Stephen, I'll throw it back to you and open it up for questions.
Terrific, Tom. And thank you for that. I continue to be amazed, as I think everybody on the call does, that every month seems to be different for different reasons. And still, I see patterns. I think everybody's seeing the patterns, but it's every month there's something new. Reminder, this is a new platform for us, so there's a Q&A bucket down there. Go ahead and put your questions in. We've got a few queued up already, and the questions are my favorite part of this whole presentation, so I encourage everybody to jump into that. Tom, our first one asks, way back in the C&I section, and we've covered this months and months ago, but the question is, what's going on with oil and gas?
So I'll get Jeremy to help me with this one as well. But within the oil and gas, it's really the upper level, the extraction and the support activities where there's problems. And Jeremy, if you're on the line, could you give us a little more color on that?
Yeah, so what you said, Tom, that if you look at the whole oil and gas or the whole energy vertical, things like pipeline transportation, that's doing okay right now, whereas the services subsector within oil and gas is probably the most stressed portion of that whole industry. We have seen over time that banks have limited their exposure to oil field services and some of the more risky borrowers in the oil and gas sector. But I think a big factor to determine how well the industry performs over the next year or so is how quickly we get a vaccine. Because I think what's really holding down oil prices is that people aren't traveling. It's putting a lot of pressure, downward pressure on oil prices. So if we can get a vaccine next year, I think the industry might see a slight rebound in credit quality. But right now, services and even portions of upstream still on shaky footing at best.
Great. Thank you, Jeremy. Also, still in the C&I world, I think going back to page 10, the question comes in, is there any indication of why the two sectors 55 and 56, which are management and admin, were hit so hard?
So in terms of 56, what we're seeing when you start dropping down a little bit, what we're seeing is it's with the waste management and remediation services that we're having that are having issues. Those are the specific industries. With the management itself, it's at for lack of a better word, I think that industry code kind of covers as a catch-all, for lack of a better word. And there are a variety of reasons why some of those companies within that industry are declining. If you want, if you could shoot me an email, whoever's asking this question, I can do some further research and send you some more information on that.
Terrific. So, Bill, that's your question, and send it over to Tom Cronin. All right, next question. Do you collect information on whether a loan has been in deferral? And do you think that the September-October rise in delinquencies is due to the expiration of those 6-month deferral programs?
So we do not collect, or we have been unable to collect information on terms of what's in deferral, primarily because the banks chose many different ways to do that. Some made the interest rate zero, others cut off the billing period, others made adjustments and waived income numbers. So we've not been able to specifically identify a loan that's in deferral. Then to the second part of your question, do I think the rise in delinquency is due to the expiration of the 6-month deferral programs? I definitely think it is. This was, if you'd been with us prior to this, we sort of have been targeting October as the month when a lot of these 6 months, if they came in April, they would have been rolling off in October and November. We thought this was going to happen, or we had feared it was going to be happening. And sure enough, it looks like it is.
Yeah, that's right. Okay, next question. Do you track TDR numbers separately?
So the answer to that is yes. We have the capability of doing that. And again, to the person asking the question wants some specifics on that. If you could just shoot me an email, I can get you some additional information on what we're seeing.
All right. Next question is from Matt. Can you please explain why the mining, oil, and gas industries are struggling the way they are in terms of non-accrual and delinquencies? And do you suspect this trend will continue? So you think that question probably came right before Jeremy spoke, but anything additionally, Jeremy, that you might want to add?
Yeah, Stephen, I'm sorry. My phone was kind of going in and out. Can you repeat the question, please?
Yep. Can you please explain why the mining, oil, and gas industries are struggling the way they are in terms of non-accrual and delinquencies? And do you suspect this trend will continue?
Yeah, so that industry's been on, I'd say, shaky footing for a pretty long time now, even before the pandemic. Kind of going back all the way to 2014, we first had the oil prices collapse. That industry saw a surge in non-accruals and really never got back to pre-2014 levels. So a lot of the non-accruals there are still some legacy loans that I guess the banks are holding on to, but still really haven't recovered sufficiently. There are some new non-accruals and new delinquencies that we're seeing that were caused by, with the pandemic restricting travel, that just put a lot of pressure on the industry. I think the outlook, again, is going to depend a lot upon whether or not we get a vaccine next year, or how quickly we get a vaccine next year, and how quickly travel will resume. But right now, because of all the things that happened to the sector back in 2014, as well as all the pressure from COVID and the travel restrictions, that's what's causing a lot of the problem loans in the sector. And as Tom said, it's really predominantly concentrated in oil field services and to a lesser extent in the upstream subsector, not seeing as many problems in pipeline transportation or downstream.
There's a lot going on there, Jeremy. Thank you. Okay, next question from Bill. Is there any indication on what percentage of the special mention are just lenders being conservative and downgrading across the board to avoid a double downgrade from regulators or internal audit?
So historically, we have, in the studies we've done, we've seen loans go into special mention and then move out. They don't stay there. This is a place where you put it in where you're just not sure what's going to happen. And historically, I'd say maybe 70% of those loans go in and then get moved out. And about half of those that get moved out go back to pass, and half go back into further, substandard, doubtful, or loss. So I would think, and again, this is from conversations I've had with other banks, that your statement is true, that a lot of people are being very conservative in putting loans into special mention, particularly loans from certain industries, department stores, hotels, things like that. And we'll see these loans move in and out. And right now they've not. A lot of them went in the beginning of the crisis and have basically stayed there. So I'm not exactly sure yet how many were overly conservative and how many of them were just being prudent.
And Tom, that sort of lines up with some of the conversations that our team has had with banks as well. Okay, next question might be just misplaced a little bit. I'll ask it anyway, though. The question is, where's my best upside for common stock, or what about value stocks? And Tom, I know that you're a big-time investor. Do you want to prognosticate for us today on that?
Well, I don't want to give away my secrets. That's made me multi-millions. But and again, not being and full disclosure, don't take this to the bank or sue me or anything like that. One of the things that I've heard is that the industries that are doing well are the ones that have low human touch. And I think, the Amazon, things like that, places where they're able to do business without people coming in and touching and running the risk of being sick.
Yeah, that's a good point. And in all seriousness, I think, on these calls, we tend to focus probably more on the credits in the industries that are having trouble. But there's probably another presentation that could be given on all of the industries that are seeing an increase in business. And that's not really part of our credit trends piece, but that'd be something to look at as well. Okay, next question from James. Speaking of vaccines, if a vaccine is introduced in Q1 of calendar 2021, do you see the lodging improving quickly, or has the change in consumer travel, will that impact them for years to come?
So this is a great question. And it's sort of a race against time. Does the vaccine get here quick enough to save a lot of these hotels? And from what I've heard, a lot of the hotels are on their last legs, particularly ones that rely on convention travel. So whether the vaccine comes in time, to be honest with you, I don't know. I think it's going to be very, very close for a lot of facilities.
Okay. Yeah, I tend to think you're on the right track there. Next question comes in from James. Any information available on senior care facilities?
So James, I do have the ability to split this out. And again, if you'd shoot me an email, I can send you some information. I do not include that in the top 8 because it's just not as big a part of the database. But I can show you what we have.
Okay. Yeah, James, that's Tom Cronin, and his email address is being displayed right now. Next question. What is causing deterioration in food manufacturing and groceries? It seems to still be an essential industry.
So I'll just relay what I've heard. It is essential and people are still buying, but the cost of the added protection of making sure your stores are clean and your facilities are clean are adding a lot of extra expenses to a bottom line that's already razor thin. And that seems to be the issue at hand. That's extra similar to what the banks were going through with CCAR requirements and things like that. This extra layer of requirements and health standards are causing a problem.
Gotcha. That makes sense to me. Well, now's your chance, folks. We've run to the end of the questions that have come in. So if you've got that burning question and want to sneak it in, now's your chance. While I'm just kind of keeping an eye on those questions, I will say once again to both Tom and Jeremy, a big thank you. I know there's a lot of work and insight that goes into this. So I appreciate your insights and your analysis and bringing forward this information. And I'm sure I'm like everybody else on the call looking forward to the next chance that we get to look at credit trends. So for everybody on the call today, go over to rmahq.org in the events area, and you can register for the next credit trends, and we'll see you that time. Something that's coming up closer to the next is our upcoming sponsored RMA webinar. This is called Managing Complaints to Achieve Better Results. And that's going to be next week. It's next Wednesday, December 9th. It'll be at 1 p.m. Eastern time. And that is sponsored by N Contracts, which means they're picking up the freight for that. Okay, I think I did a good job of delaying just a little bit. Got one last question. This seems to come up every time. Is this recording and presentation available offline? And that's definitely going to be the case. For everybody that's registered, we give you the link for the recording as well as the materials. And Christopher, if you had trouble with getting last times, you can send an email to me. I'm Stephen Martin, and I can get you those links. One other question that came in, does the data include community banks and CDFIs?
So again, if somebody would whoever asked this, shoot me an email, I can tell you who's part of the service.
Terrific. Well, that's great. We're at the end of all our questions. So just again, thank you for everybody. I know you've got a lot on your plates, and we all appreciate you spending time with us on these credit trends. So this concludes our webinar. As always, we like to get some feedback. So at the conclusion of this event, there's going to be a post-webinar survey, and we read all of the comments and we take your evaluations very, very seriously. And so please take a moment on that. That'll help us improve for the next time. So thank you again, Tom and Jeremy, and everybody on the call. Have a great day.